there, folks, and welcome into this video. This is a fun one. I look forward to these type of videos. Basically, what we're going to get into here is I'm going to take you through 9 stocks, okay? 9 stocks that I absolutely love in the market that are under $15. And then I'm going to share 2 stocks that I'm looking into right now that I think could be very interesting under $15 as well. So let's just jump into this, guys. Hope you enjoyed today's video. I appreciate you joining me, spending some time with me here, talking about some good old stocks and why I like these ones, okay? So we're going to look at kind of, what's been going on with these stocks, and we're going to look at what analysts expect for estimates for these stocks and things like that, and then we'll just kind of run from that, and I'll kind of give you my opinion on if I think these companies are likely to beat earnings, miss earnings, things like that, okay? Or at least their numbers over the next year. Let's put it that way, not really earnings, more over the next year or so, okay? So first one up here is Palantir stock. So Palantir stock, as far as what analysts have their estimates for 22, okay? About 29%, 30% revenue estimate. I think they can definitely come in line with that. Maybe if it's a really good year, they could maybe potentially beat those numbers there. Next year, also expected to be right around that 30%. Analysts right now have them at 28.5. Alex Karp, CEO of the company, said that he expects the company to be able to, hit 30% year in and year out for the next several years. Also expected to do 20 cents of EPS from 13 cents a year ago. Don't be surprised if they come in with a slight beat there. I think they'd come in with a bigger beat if it wasn't for the fact that they're hiring so many salespeople right now. So hiring that many salespeople, the good side of that is, okay, the good side is they're going to get a lot more revenue from salespeople, right? But the problem is sometimes these sales cycles can be 6, 12, 18 months when you're talking about selling to a company, a B2B type big deal. That's let's say it's a $5 million deal, a $10 million type deal. Those don't happen tomorrow. Many times those big, huge deals, they take, 6 months, 12 months, something like that. So when it comes to Palantir, I think they're going to get more use out of their sales force as time ticks on, essentially, right? Next year, expected 27 cents. I think they're going to come in with a massive beat next year. I think that's going to be their big EPS year. And I think that goes for a lot of stocks. I think it's going to be a fun EPS year in 23. I think 22 is kind of, it's kind of a shaky first half for, I think, a lot of these companies, but with revenue accelerating in the back half of the year. And then, some pretty exciting numbers come in 23 as far as EPS side. As far as Palantir stock, it has been ugly, okay? It's been no bueno for the stock, right? If we go back to September, the stock was trading at, what was this, 28 bucks? Oh gosh, it's back in September, $29 there, and it's just been on a vicious fall. Even if you go back to late, early to mid-November, stock was 26 or so. And so the stock's gotten absolutely devastated. I think it's a really attractive company because these sorts of companies, Palantir, in my opinion, will always trade at a premium because they're a premium business model and a very sticky business model. So I think they're in a pretty great position. Let's just put it that way. And so that's why I think they're definitely one of my favorite stocks under $15. Another stock I personally own. I own a lot of these stocks we're going to go over here. Palantir is not one of those yet, but I could definitely own Palantir pretty darn soon. Okay. The Chef, I think everybody knew this one was going to be included in stocks under $15. Now, when it comes to Chef and as far as what analysts are expecting from this company, so in 22, we know the Yahoo Finance should update the 23 numbers as soon as basically the earnings come out, this last earnings here, okay? But as far as 22 goes, analysts have them losing 30 cents. I'm pretty in line with that. I think that's roughly what they do. Maybe they come with a little better number than that. As far as 22's revenue growth, 32%, I think that's definitely very doable when I think about the expansion of their products into new stores that they just really got into in Q4 and in this quarter we're in right now, Q1, which won't be reported for another 3 months. When I think about their new products they got coming, I don't know if you guys have seen, but they got new frozen burrito products coming. They got new nutritional bars, things like that. They showed off some of those very recently, which is really, really darn exciting. And that will help out margins. Tattoo Chef, I'm not really too concerned about margins in the short term or profitability, but I know there's definitely a lot of folks on Wall Street that want to see margins improve, and I think you will see margins improve over the next 18 months. So yeah, I think that's definitely very doable numbers for Tattooed Chef. The market cap for the chef is trading around $1 billion roughly recently for Mr. Chef. Yeah, we're trading at 1.03 billion for the chef. It's trading at pretty much the cheapest price to sales ratio it's ever traded at. And, recently it has been showing some strength, which is interesting as far as the stock price goes. It's actually been in a very vicious market where tons of stocks have been getting tore up. this one hit its lows around January 24th, and since then it's come back, and basically it's just been kind of holding strong in a very, very bad market. So the Chef is a multi-year play. All these stocks I'm sharing with you here, all these companies have, I would call it, multi-year things going for them. So it's not like they just have there's one thing going for them and it's great today and then it could go bad tomorrow, because I think a lot of times people get caught up into those sorts of stocks, right? Even right now, as I'm recording this video, oil and gas stocks have been the hot stocks, right? Those are the hot stocks until all of a sudden oil fades. It's a commodity at the end of the day, right? And so that's a tough thing with a lot of those plays. All these stocks I'm sharing with you, they have 5, 10 plus years of massive growth ahead of them on top line and bottom line. Companies like Palantir, companies like the Chef, and all these ones I'm sharing with you here. Now, this other one, this one's valuation is just silly, okay? I think, Voyager Digital. So I think everybody knows that I'm not the biggest, necessarily the fan of crypto, and it's not like I'm out there buying Bitcoin or something like that. But I will say, Voyager Digital, which is a crypto brokerage, this stock is heavily undervalued right now. Okay, so as far as the year we're in, 21, 14,000+% revenue growth. In 22, this company is expected to have revenue growth of over 200%. Over 200%, and you got to be flipping my flapjacks. It's ridiculous. Okay, and this is a small market cap company. They're supposed to be profitable and extremely profitable, right? $1.15 of EPS in 22. Voyager Digital just gets disrespected because at the end of the day, this stock is an OTC stock. And when it comes to OTC stocks, no one really wants a piece of those type of stocks in when it comes to Wall Street. They're not. Some funds can't even own OTC stocks or don't want to hold those sorts of stocks. So this stock has gotten absolutely devastated. I mean, this was a $20, almost $30 stock not too far ago. I mean, even if you go back to November, this was a $20, $21 stock, and here today it's $6. $6 for one of the biggest crypto plays out there. I think that's just silly. The stock's gotten extremely undervalued, and Voyager Digital is just another one of those companies that, outside of a multi-year bear cycle for crypto, I just see them getting bigger and bigger and bigger and more successful. So yeah, that's one that's one of those stocks under $15 that's just like, come on, man. It's shot way too far to the downside when it comes to Voyager Digital. Next one up here, I don't personally own this stock, but I gotta say it's shot way too far to the downside, and it's Stitch Fix. So Stitch Fix is supposed to lose 93 cents a share, essentially in 22. Revenue growth is only supposed to be 8% for this company, and 22 is what they're expecting. Next year is supposed to get back to 12%, so a reacceleration of growth is expected in 23, and then closer to profitability. But when it comes to Stitch Fix and why the stock has been falling so much, the stock's down over 90% for reference. If you didn't know, which is insane, over 90% fall for the stock in the past year. But this one's just been getting absolutely devastated, and the reason being is it's a money loser. The market doesn't want any part of money losers in the short term, right? And not only that, the revenue growth isn't the most exciting if you're talking about single-digit revenue growth in 22. But at the end of the day, this market cap's fallen dramatically. It's a little over $1 billion. At one point today, it would literally fell under $1 billion market cap. Okay, it was down to 800, 900 mil at one point. Okay, but when I see Stitch Fix, I see a business model that's going to, thrive more over the coming years, with obviously workplaces opening back up and just, the world getting back to normal. Let's just call it that. And so a clothing business like Stitch Fix will thrive in that sort of environment. There's no doubt they're in a tough position right now when it comes to their EPS, but at the end of the day, there's a company doing $2+ billion of revenue expected in 22 for this company, right? And it's trading at a price to sales ratio that's by far and away the cheapest it's ever traded at, a 0.51 right now, right? It's a stock that usually trades at anywhere from 2 to 3 for the most part. So 0.5 is shot way too far to the downside. And, I think it's going to be one of those stocks that has a pretty good next couple of years. So Stitch Fix absolutely is a pretty darn good stock in my opinion. That's under $15 here. Honest is the next one up here. This is one I have personally been buying very heavily, and I went on record and I said it. Honest is the best risk reward in the entire stock market of any stock I possibly know, in my opinion. I cannot find a better risk reward profile for the next 3 years than Honest. It's Honest and then it's everything else. And so that's why I've been buying the stock so dang heavy. And that goes from large caps, mid caps, small caps. It doesn't matter what it is. I can't find a better risk reward play than Honest for the next, let's call it 3 to 5 years. Okay. So when it comes to Honest, the stock is just another one of those that's been devastated recently. If we pull up Honest's stock price here, you'll see They went public in, or it was around May-ish or so. And yeah, right around May at $20-something a share, and just immediately it started falling and falling and falling, and it's never come back, right? As far as the stock price. And price to sales ratio 1.6 in this company is kind of laughable, that price to sales ratio there. Essentially, companies like Honest should be trading at least at a 3 price to sales ratio. But with a growth company like Honest, in this industry, should be trading really more toward a 4 or 5 price to sales ratio. So just off valuation alone, the stock should double. But that's just a small component of it. So right now they've been losing money, right? But next year they're expected to get closer to profitability with a 12-cent loss. This is huge. And when they flip that baby to profitability in 23, massive for the stock price, okay? And in attracting a real shareholder base in this one. As far as next year goes, expect to have 13% growth, 366 mil. I see that completely doable. I have no concerns about that at all. And like I said, this is the best risk reward play I can find in the entire stock market. It's Honest, and then it's everything else. And so Honest is a company that honestly I could see myself potentially holding for years and years to go in the future, because I think once they do start to get into really, really nice profitability, I think they'll be one of those companies that if they want to turn into the future Procter & Gamble's, Johnson & Johnson type companies, Kimberly-Clark, and pay dividends, they'll be able to do that. It's just a question of, do they want to do that, or do they just want to continue to grow that top line and really focus on that? That will be the big question for Honest. So I absolutely love that one. This one here, they reported earnings here today, okay? And that is Oatley. So when it comes to Oatley, this ain't no dang jokely. Company guides for about 900 mil-ish, or a little over 900 mil for revenue for 22. So that disappointed analysts. Analysts were expecting $1 billion of revenue. So to come under that, analysts were disappointed. Still, at the end of the day, 900 mil is still going to be an incredible growth year for Oatley. It should be roughly close to a 50% growth year for Oatley. And the thing with Oatley is this company has so much growth for this next decade, it's ridiculous. Their products just continue to grow and grow and grow. Their SKU expansion into stores, their velocity, meaning how many products they move from the amount of shelf space, is going to increase dramatically over the coming years, because their velocity moves so fast. As far as, they could have like 7% of the shelf space, right? 7% of the size, but be moving like 20% of the volume, 30% of the volume in their space. And so with all these grocery stores and retail chains and everything, look for Oatley to have massive displays over the coming years. They're expanding to so many different products. That one, I don't know when Oatley stops growing, but it's not in this decade. It's just an extraordinary company. Now, they went public at a very bad time, kind of like Honest did, right? And so a lot of these companies went public at, kind of right around the peak FOMO cycle. And they've just never been able to catch a break. And that's the same exact thing with Oatley. Oatley hasn't been public for too long, only, less than a year. And look at this one. It's just been, devastated. It's never been able to build a big shareholder base. It went public when, all the stocks were hot, and never built its big shareholder base. And here it is, just a stock that's just kind of floundering here. This is one of those stocks that I'm looking at as a buy this entire year. So I'm hoping to just continue to buy up shares of this stock while it's hopefully in the $5 range. I'm willing to pay all the way up to $8 for Oatley in the short term. I'm hoping it stays under 8 for this entire year. 4, 5, 6, 7, those type of prices. And I'll just continue to acquire shares of Oatley. It is a European company, so it's one of the very few that I'm actually, an owner of that's a European company. But my gosh, okay, their growth for this company over this decade is going to be ridiculous. This is going to grow into ultimately a food giant and a drink giant, right? In their industry. So yeah, Oatley, it ain't no jokely. I love that one. Next one up here, this one is the Planet, okay? Yes, the Planet. So when it comes to Planet for 22, companies expected to have about 20 cents EPS. EPS is messy for Planet. I don't know what to expect the more I've thought about it. With them opening up a store in Chicago, with them opening up potentially several stores in Florida, I don't know what that's going to mean. Obviously, the Orange County stores continue to ramp, so I'm assuming starting this summer, that store will likely get very, very profitable. But with that being said, I don't it's a tough one for me in terms of EPS. I really have no expectation. I wouldn't be surprised if they had a very small profit. I wouldn't be surprised if they had a bigger profit. But the Planet, this is, once again, to even care about EPS right now is kind of silly. This is a company that's expected to have 50% plus revenue growth in 2022. So, and obviously you see the stock price there. It's a $2 stock here today, right? Which is just crazy that this stock's been hit that dang hard, but it has. And this stock was flying high. It was $6-7, and then they haven't done anything wrong with their business model. The growth has been tremendous. It's just the problem is retail. This is a stock that was very supported by retail investors like myself, right? But the problem was it wasn't just people like me. It was people that just gotten in the market and folks that were playing the hot stocks and those sorts of things at that moment in time. And so a company like Planet, they report these tremendous numbers, but it all has added up to nothing over this year. And here it is, a $2 stock essentially today, right? And we will get back to $7, and we will get back a whole lot more than $7 over the coming years, in my opinion, when it comes to Planet. But, for the short term here, it's just in a really, really tough place. And this is not a stock that, Wall Street's behind right now because the product they sell is still federally illegal. So once that gets legalized, I mean, that's just a huge growth vector for not just Planet, but everybody that competes in that space. And so I look at the Planet and I'm a happy holder of that stock. Great balance sheet, great management team. Obviously the growth is tremendous for this company, and I can see it playing out like that for quite a while. Market cap on this company is right around $541 million for this, which puts it at a forward price to sales ratio of around 2-ish roughly, or just slightly over 2 on a forward basis. So yeah, the Planet, I love that one. It's dropped so much. I mean, look at the price to book, on this one. It went from 7, 8 to it's a 2 price to book now on this one. That's just crazy, okay? This next one up here, it's another $2 chuck stock. This one, I will say, much riskier stock. This one's a much riskier stock than anything else on this list. But I will say, over the next 2 years, it probably has the most reward potential, and that's Smile Direct Club. So Smile Direct Club, as far as this one goes, analysts have them losing a lot of money this year, 51 cents a share. Yeah, I can see them coming in with some sort of loss like that, maybe slightly better, but somewhere around there. Expect to have 4% revenues decline this year, which is mainly because they're pulling out of some markets that just weren't, were just so unprofitable, it didn't make sense. And so it helped the revenue lines, but it devastated them on EPS. And so I actually like that move. I think Smile Direct Club should focus on right-sizing the business and get out of these massive losses the company has been taking. When I look at their product, I think it should be very, very profitable. And so I think they're focusing on the right things. As far as next year, they expect to get back to nice growth, 18%. When I look at this industry, right, if I think about straightening of teeth, braces, all that stuff, right, which obviously Smile Direct Club sells clear aligners, man, the worst thing for that, the worst thing for that industry is a situation where everybody can wear masks and people don't have to go to work or go to school in person, those sorts of things. All that's going away now. And so people will be concerned about their teeth again. And a company like Smile Direct Club is one of the biggest beneficiaries of that. Align is their only big dog competitor. And so I think Smile Direct Club's set up for not just great next, let's call it 5 years, but I think they're actually in a sweet spot for the next few years as life begins to get back to normal. And this stock has just been obliterated. I mean, absolutely obliterated. If we pull up Smile Direct Club, this is a stock that a year ago was, $12 or so. And, here today it's $2. It's a $2 chuck. The market cap's fallen in this one to 854 mil from, look at this, 4 billion plus back a year ago, right? 4 billion plus. The price to sales ratio on this company now has fallen to 0.41. 0.41. That's insanely low. And so Smile Direct Club, let's be very clear about this one. It's priced for bankruptcy. And I think there's a high probability they're going to make it through and not go bankrupt, and will emerge as a, $5, $10, $15 stock, probably within the next 24 months. So I'm actually placing little chips on the table. Like I said, it's a higher risk play, so I can't risk a farm on that one, although it's tempting. I got to kind of be a little controlled when it comes to STC. Like I said, that one's the riskiest. This one here I'm about to share with you, I don't personally own it, but this is the second riskiest stock of this bunch. And I'm intrigued, okay? Let's put it that way. So it's Fubo, okay? FuboTV, $7.55 here today. They are a massive money loser. $2.59 this year, expected $2.23 next year. No one likes a money losing company right now in this sort of market, right? But gosh, man, you look at the growth of this company, 74% revenue growth expected in 22. And basically, Fubo, they're a competitor to like YouTube TV and other products that compete in the streaming space, and they really focus themselves on sports. I think it could be a great acquisition target for, honestly, somebody like, I think ESPN, which is owned by Disney. I think it could be a good acquisition for them. I think it'd be a good acquisition for somebody like an Apple, because Apple, essentially, they're getting bigger and bigger into sports. We'll see what happens there, but at the end of the day, I think they got a pretty, there's no doubt there's a lot of people that want to use Fubo, and they're growing beast. Even next year, even though growth is expected to decelerate as far as 23 goes, it's still expected to grow almost 42% there, okay? If we pull up the Fubo here, it's no bueno, okay? It's no bueno if you look at the stock price. It's been nasty. Look at this, okay? So right here, stock peaks out about $34 back in November, and it's $7 here today. $7. That's vicious. Stock's down 77% in the past 1 year. In this sort of market, they want no piece of this one. And price to sales ratio has come down massively from about 14 at the peak to here today. It's a 1.8. 1.8 price to sales ratio. Market cap's trading 1.1 as far as that goes. So if you're looking at a forward price to sales ratio, you're at about a 1 right now on a forward price to sales ratio basis. So yeah, Fubo, not one I personally own, but I'm contemplating it. It's just a question is, I already own a very risky play in Smile Direct Club, and it's like, do I want another really risky play in Fubo? So that's a tough thing I'm trying to figure out there. Now, 2 stocks I'm still doing some work on here that seem pretty darn intriguing that are under $15. One is SoFi, so I'm doing some work here. So another money-losing company, expected to lose 39 cents in 22. And by the way, in terms of a lot of these money-losing companies, that's what you're going to find a lot of times. If you're talking about stocks under $15, that's what you're going to find. You're going to find a lot of money-losing companies, especially if they're high growth. That's just what you're going to find. But look at SoFi. 49% revenue growth expected this year. Another 40% plus in 23. Gosh, I got to say that's pretty darn interesting, right? And if we go ahead and we pull up SoFi here, so this stock's down about almost 50% in the past year. It's really been vicious from the peak here in November. Oh, November 11th. Okay. Veterans Day, $24.60. It's $9 here a day. So since that time frame, the stock is down. What is that? Like a 60% downward move roughly there. I mean, that's vicious for SoFi. So right now, trading at it's still a 9.5 price to sales, but look at the price to sales in the past, a 50, 55. So yeah, obviously there's a lot of retail investors or traders in this stock, and I got to figure out, what's the truth in this one? Does it really have this big opportunity? The growth the analysts have, the 8 analysts cover it there, 8 analysts cover it there. That growth is a no joke as holy smokers, 49%, 41%. You gotta be flipping my flapjack. So that's one I'm just doing more digging on right now because it's no joke. The next one up here is Purple Innovation. This one I'm much further along in my research. I've been researching this one for a couple months now. Purple is a mattress company, bedding company, those sorts of products, pillows, mattress toppers, mattresses themselves, sheets, comforters, all that type of stuff, right? When it comes to Purple, they're expected to lose money, lose about 4 cents, but it's a very small loss in 22. That's an important thing. It's not like it's some crazy loss that it's like, I don't know how they're ever going to make money, kind of like, let's say a Fubo or something like that, right? But at the same time, it's not a big revenue growth, only 4% expected in 22, 12% there. But this one's gotten so cheap market cap wise, and based upon kind of all those financial metrics, that it actually kind of has me intrigued a bit here. So the stock has fallen 78% in the past year. That's just a vicious fall. But price to sales ratio on this one's now 0.65. Market cap's under $500 million on this one. So yeah, I need to finish up my research in Purple. It definitely seems intriguing. But yeah, guys, those are the stocks under $15 that I think are pretty interesting buys now. Let me know what your opinion is on any of these stocks. Do you own any of these stocks? Do you have any insights on any of these stocks? I love reading through the comments all the time. Hope you guys enjoyed today's video. And lastly, before I let you go, 2 things, okay? basically as pinned comment down there, you're going to see one link that is to Moomoo. Basically what they're doing right now is a free, if you deposit any amount with that pinned comment down there and set up an account with them, they're doing 3 free stocks right now. I don't know how much longer they're going to do it, but it probably won't be for too much longer as far as any deposit. And second thing you'll see down there is my stock market investing mastery course, which I've made free right now. It's just an 11-part course. That's great if you've been investing in the market for less than 2 years. So you get a tremendous amount of value out of that. And that's absolutely free. So check out that as a pinned comment as well. Thanks for joining me, guys. Much love as always, and have a great day.